folks. This is Mitch Firestone with Precision Trading Labs in New York City. It is August 26th, 2022. And I want to take a few minutes here and go through kind of a bunch of stuff. I'm going to do a little market overview here, also talk about some trade management items, as well as a handy tool to help you along with, getting some generally useful information that you should always have at your disposal when you're trading. And then after the market overview and that stuff, I will talk a bit about do a couple of review of a couple of setups, talking about the whole concept of supply and demand and how that leads to high probability trade setups. And then lastly, we'll actually finish up by looking at a couple of live setups that we're waiting on. Okay, so anyway, so that's the agenda here. I am what we're looking at here is is a daily chart of the SPY, and in fact, we are in the midst and coming into the home stretch of probably what's going to be the ugliest day, ugliest trading day that we've had in 2022. Coming up on, let's say, the first 9 months, wrapping up the first 8 months of the year. This looks like it's probably going to be the ugliest day that we've had thus far. If we just look, this is a daily chart here, and if we go back to the beginning of 2022 here, I do not see any red candles that are quite this large. And in fact, it looks like we're going to close pretty much at session lows. So this is a pretty ugly day here. As you can see, we're down about 3.25% here on the SPY. And of course, as a psychological thing, we are now heading back towards that psychological round number of 400 on the SPY. So it'll be obviously interesting to see come Monday whether, in fact, that might come into play in terms of the market looking to kind of give it some support at 400, or in fact, if we end up kind of dropping to, let's say, this pivot right down here, which is sitting at around, what is that? This is around 389, 390 right over here. So to some degree, if we don't get stopped by the psychological number of 400, I wouldn't necessarily be all that surprised to see us come down again to kind of this pivot low here. So those are kind of the two key levels of what we're looking at here. This thing actually drove through a demand zone, which under a lot of other circumstances conceivably might have actually turned price. As you can see, price came down into this demand zone here, kind of came down near the bottom of the level, actually spiked out of it yesterday, which of course was Thursday, but today on Friday, this thing has gotten decimated. And there's a reason for that. You can see I have some notes here in the chart. Today, Jay Powell, the chairman of the Federal Reserve, he came out had some monetary policy comments today, which were not favorably received by the market. Might turn out to be good for the economy and good for consumers, but definitely not good for the market. Basically, kind of telegraphing some further hawkish monetary policy by virtue of raising interest rates, continue to do that in order to essentially kind of, basically reduce the money supply, reduce demand for homes, basically try to slow economic activity in order to combat inflation. So he kind of made all these comments that all allude to that goal, and particularly hawkish monetary policy. And as a result, the market is not it did not take kindly to that today. And so that's why we're looking at this really ugly day here today. In addition, there were also some inflation numbers that came out this morning at 8:30. I think it was 8:30 Eastern time. And in fact, those were actually relatively favorable, basically showing that month over month from August back to July, in fact, prices overall actually held steady. Showing that we may have actually kind of started to perhaps hit a peak on inflation. And of course, part of that peak is going to would be due to the prior economic policy, the monetary policy that the Fed implemented. But because of the fact that there is still some major signs of inflation that could very easily ignite again, they're going to continue to kind of try to keep put a damper on economic activity. And of course, the problem with that is trying not to overdo it, because then at that point we may just get driven into a recession, and it'll become a self-fulfilling prophecy. And that's the balancing act that the Fed has to go through. But at any rate, from the perspective of us as traders, though, and particularly swing trades, I just want to show you kind of a really quick tool here. If you look over here, this is a website called Forex Factory. And what this is that this is an economic, the main feature of it is an economic calendar. And so as a result, we can always see, you should always have a couple of these at your disposal here in order to know when there are scheduled economic announcements that are obviously going to affect the markets. And so this way you can be prepared for that. And one of the reasons I like this one is because it's actually keyed to, it's also keyed to foreign exchange. So these are all these economic announcements here, which says USD. So these are all things that are going to obviously affect the US dollar. Here are things over in Europe, of course, which are going to affect the euro. So there's the EUR there. And so as a result, this I kind of like. I particularly kind of like this one here because of the fact that I and some of other people in our group we trade currency futures. So as a result, always being aware of when there are going to be key economic announcements that will impact particular currencies is often very useful. So we can see right here at 8:30 a.m. Eastern Time, right here. This was the economic. This was the inflation numbers that I was just mentioning a couple of minutes ago. And so right there you can see it was up. It was actually down 0.1%. So showing showing that in fact inflation perhaps may be starting to peak, but that's no guarantee of that yet. And then right here at 10 a.m. right here was the notice in advance, of course, that Chairman Powell was going to make his statement today. And so as a result, just going into today, between the inflation numbers coming out as well as knowing that the Fed chairman was going to speak, yesterday when I was in a trade, I actually kind of cut the trade short, where I might have maybe given it another day to see if it might have actually continued to go in my favor. It was a bullish trade, which I'll show you in a minute. I just decided, you know what, I'm just going to kill it right here because A, I wasn't necessarily in love with holding the position over the weekend, and then on top of it, knowing that the monetary policy discussion was going to happen today, as well as knowing there were more inflation numbers going to come out today, the two of those things combined, this led me to be a little cautious. So one of the things you should always do is have at your disposal an economic calendar. And again, I happen to like this one at Forex Factory, but you can find them, they're everywhere. Bloomberg's got them, obviously. CNBC's got one. They're all over the place. So you can always grab one, but you should definitely have a couple at your disposal. And in fact, I always have a couple at my disposal, just for the practical reason that if for some reason there's a problem with one website, I'm not going to get caught in a lurch having to find another one. So you should definitely have a couple of them saved. This way, you'll always have that information. So at any rate, so that's the deal here with monetary policy and all that kind of stuff. So I want to kind of go in and showing the SPY here. So what I'm going to do now is I actually want to do a quick review of a couple of recent trades here, and I'll also talk a bit about supply and demand and how we kind of use that as the basis for creating setups. So I'm going to show you this setup that I had here on Qualcomm here. And so here is the kind of what we think of as the before picture. And so these were screenshots that I did at the time. So this was taken on July 22nd, so about a month or so ago. And this was a 2-hour chart. And so this was an area where what I was looking at here was Qualcomm at the time was basically starting to had actually emerged from being in a downtrend where it was making lower highs and lower lows. Right here, it actually broke out of the downtrend here, and actually it then made a higher low down here, and then made a higher high over here. So at that point, I was looking for a pullback into this region here, and this is kind of a pivot but this is also an area of what's referred to as demand. Right here we had this bearish candle here. Notice we had this little area of consolidation here. Okay. Okay, and if we just blow that up a little, we can see there's that little that sort of indecisive green candle in there. And then notice we had a considerable gap, and then a very bullish candle and another bullish candle here. And so this was an area where price came down, consolidated, and then popped. And so the theory here is that price only spent a very small amount of time over here before it popped. So essentially, there's the thought that either literally there are unfilled buy orders here that are waiting to be tapped if we ended up getting a pullback here. But if there aren't, even if there aren't literally unfilled buy orders, this was an area of interest where traders wanted to trade here. We kind of consolidated here for, basically for like really a half a day here. And then immediately there was some change of perception. And that change of perception was, something happened. I don't necessarily know. This may have been just responding to the general market, or there maybe Qualcomm perhaps maybe said something at some point. But as it certainly wasn't an earnings announcement or anything like that. Because in fact, I had a note here, and this is the other trade management comment that I had here. So when I had set this trade up here on July 22nd, I also had this note in here that the next earnings announcement was going to be basically exactly a month in advance. And so that kind of gave me notice that if in fact I ended up getting into this trade, I wanted to be out of it before the earnings announcement. So this was going to be at the end of the day on the 23rd. I would probably I would probably want to be out of the trade on the 22nd, or perhaps if I was going to give it till the morning of the 23rd. But at any rate, I definitely wanted to be out of the trade before the earnings announcement. So consequently, having this in here was good. It was a reminder that this is kind of the end point of if the trade triggered at some point over the next few weeks, I wanted to be out of this trade by here. Okay. So at any rate, right here, this was our area of demand here, and the reason we call this reason we think of this as demand is that right here, this was an area of equilibrium where willing buyers and willing sellers consolidated, and then all of a sudden they were in agreement, but then all of a sudden there was an exhaustion of sellers here. Nobody wanted to sell at this region anymore. And so consequently, if all you have are willing buyers here, but you don't have any willing sellers, okay, what happened was essentially buyers ran up the price chart here until they encountered willing sellers. Okay, so right here, this was an exhaustion of sellers here, but there was no. This was an exhaustion of sellers here, and there was only willing buyers. Consequently, if all you have are willing sellers, if all you have are willing buyers, but you don't have any willing sellers, okay, we can think of sellers as being essentially the supply of shares at a particular share level, at a particular price level, and we can think of willing buyers as the demand for shares at a particular price level. And where you only have willing buyers, but you don't have any willing sellers, that shows essentially that there is only demand for shares, and as a result, there is no supply of shares here. Consequently, we think of this as a demand zone because there's a demand for shares here, but there is no supply of shares here. Okay. Right here, if we look right over here, this was an area. Even though I would never have traded this because of the structure and it was sloppy, we can see right here price came down. Notice price kind of went sideways, and so this was kind of perhaps an area of a sloppy supply zone here, where essentially what happened was we had supply of shares around here, and then all of a sudden when price dropped out of here, there were no more willing buyers, but all there were willing sellers here. And so as a result, we can see, of course, that turned out not to be the case, and it really was because of the fact that this was a sloppy zone, okay, as opposed to this, which was kind of you can see this is a more concrete, neat structure here, okay. So at any rate, this is the basis for this trade here. So we're waiting for price now to pull back here and then I was waiting for price to pull back here in order to go long. Another comment about this particular trade was, this was basically under normal circumstances, the bottom of this zone here was about 140.80. And under normal circumstances, I would have probably put the stop at around 140 and 50 cents, okay, or 140.30. But because of the fact that the round number, that psychological round number of 140, was sitting immediately beneath this zone, I actually made the decision I was going to give this thing a little more breathing room. Consequently, rather than having the stop at 140.30, I actually decided to put the stop at 139.75. So in fact, I was going to give it an extra 50 cents. And of course, the consequence of that is that by doing that, it obviously gives the trade more room to breathe. But then, of course, there's no free lunch in this world. And what happened was, if you're going to give the trade more room to breathe, and you're going to give it a wider berth, well, then essentially that's going to mean that you're going to reduce your share. You're going to reduce your position size on the trade. Because essentially the way we kind of look at the world is we more or less want to kind of keep our risk per trade roughly equivalent from trade to trade in order that we can actually have a trading plan that we can actually plan on and sort of set up some financial trading goals. And so as a result, if you're going to give yourself more room between the stop and between the entry and the stop at, that's essentially you're going to be having more risk in the trade. And if you're going to have more risk in the trade, well, then obviously you're going to end up reducing your position size. Okay, and I'll kind of show you this in one of the setups that I have set up here. So at any rate, this is the Qualcomm setup, and I decided and what I shared with our subscribers was there were a couple of ways we could either express this trade, either just buy the stock right here, or actually utilize by buying a call. Okay, and so you could either buy the 140 call or the 145 call. And at the time, we were trying to see if we could keep buying the 140 call would have actually made this thing considerably more expensive, something in the territory of about $14.50, I believe. And so we basically said, okay, buy the 145, which would have been just slightly out of the money, since you would have been buying it when the pullback of around 142. And so if you bought the stock with a 145 call, well, then obviously you would have been about $3 out of the money. And so, of course, that would have meant that we would have been running a delta of probably just a bit below 50 at that point, since this thing would have been slightly out of the money. So at any rate, that was so that's what the setup that's what the setup looked like here. And let me just bring up this thing here. And so there was Qualcomm, and if we now kind of bring that up here, so here was our original setup here. So you can see price ended up pulling back here. It actually went to the bottom of the zone here, and it may have gone a couple of pennies beyond, but it certainly went nowhere near the 139.75. I think it actually only went down to about, I don't know, 140 and 50 cents or 140.40. So it certainly went nowhere near the 139.75. So it turned out, in fact, I was wrong about giving this thing more room. And as a result, it turned out if I would have just gone with the normal stop, I could have traded 3 contracts rather than 2. And the reason we did that is that with our subscribers, we basically set a $250 risk profile on the trade, and we just kind of arbitrarily decided to use that. And so as a result, this, looking at the options platform, this told us that we would be allowed to trade, if we would have traded it with using the 140 and 30 cent stop, we would have probably, if the trade didn't work, we would have probably lost, let's say, 85 cents or so on the options trade. And so that would have allowed us to trade 3 contracts, because if you have a $250 risk profile for the trade, and you're going to lose on let's say, approximately 85 cents per contract, well, if you divide the 250 by 85, that basically means you could trade 3 contracts. On the other hand, using this wider stop, that really ended up creating a wider risk profile, and then as a result, I ended up changing that from a 3 contract, 3 call option trade to a 2 call option trade, because of the fact that there was a wider zone. Okay, so at any rate, here was the setup. So we ended up when we ended up getting into the trade, the option, that call cost $9.15 at 142. And we got in on the 29th of July. And then a couple of days later, I guess that's about three days later or so, on August 1st, ended up cashing out on this. And so when it got to 148.73, that call was now valued at 12.90. So it went from 9.85 to 12.90. That's a $3.75 difference. And as a result, that translated to a 29% gain on this options trade. Okay. So at any rate, that was the that trade here. And let me show you another quick review here. Let's see. We can look at ANF here, which was Abercrombie and Fitch. So here was ANF. So here was a short. This was a short trade or a bearish trade. And again, the two ways to express this trade. One would be, of course, to simply short the stock, and of course, the other way to express this trade would be to buy a put. Okay, so right here, this was the setup that we were looking at here. Again, on the 22nd of July, right here, price came up, and this was our last earnings announcement right here, which was at the end of May. Okay, so and then here was the next earnings announcement that was due to come up 3 months later, of course. Which in fact occurred yesterday on the 25th. So right here, this was an area. Notice price came up, consolidated here. This kind of turned here, and then notice we had a bearish candle here, and then price dropped down here. And so the way we looked at this is that right here, price consolidated. Right here, you had willing buyers and willing sellers. Right here, of course, all of a sudden there were no more willing buyers. And so essentially what happened was that the sellers ran down the price chart until they found willing buyers in order to kind of meet up with them. And that's where these trades occurred. Okay, so the theory, of course, being is that when price returns to this level, there is still, in all likelihood, there is still buying pressure that's just waiting to be tapped. It just never got the chance to happen because price basically only stayed here for a couple of days. Okay, and then all of a sudden price left here with a tremendous amount of energy. Okay, so it didn't just kind of creep out of here, it kind of came out of here with some violence. And so consequently, the thought is when price returned to this level, we would then see another shot down, thinking that essentially there was untapped buying pressure that's still in there, and it just never got the chance to be expressed because of the fact that price only spent a very brief amount of time here. Okay, so that's the theory behind this setup here. And so again, when price came back here, this is what the trade looked like. So we were going to enter here. We were okay. If it didn't work and it didn't go well for us, this is where we would get stopped out. So if we were doing this with expressing the trade with the stock, well, then this would obviously be a $1.30 loss on the stock, right? So because the fact that it would have gone from 22.15 to 23.45, that would have been a $1.30. Okay, and so as a result, if you traded 100 shares, obviously that would be a $130 loss. 200 shares would be a $260 loss, et cetera, et cetera. On the other hand, if one wanted to express the trade using a long put, okay, well then this was the setup using the long put, buying the October 21st, 21st expiration, the 25 strike. So at that point, then unlike the other trade, the Qualcomm where we bought it slightly out of the money, this one we would be buying it actually substantially in the money because we would be buying the 25 put, but in fact we would be buying that at 22.15. Okay, so this would be so this is where we would be basically be buying it a couple of bucks in the money, and so we'd be basically waiting for price again to come up here. And the platform said that the estimated value of this when it got here, and looking about, let's say, a week or so into the future, or a week to 10 days in the future, and I looked at the options platform, and then I kind of sort of just put my finger in the wind and said, okay, it looks like uh, this option will have an approximate value of about $4 when it gets there. Okay, so that was the setup there. And if we now go to the okay, and so right here, it got up here on the 16th of August here. Okay, and then at that point, it basically came up, dropped, kind of dawdled around there for about 3 or 4 days, and then we had a couple of shots down, and then right here on the 24th, this is where I decided to pull the plug. And the reason I decided to pull the plug was because the earnings announcement was going to be the next day on the 25th, and I did not want to be in this trade because I'm really just, to me, more often than not, unless you're building a trade very specifically to be trading earnings. At that point, though, if you're just sort of in a long call or a long put, really you're just gambling at that point. And I was more than happy to just kind of go, okay, you know what, I was in here for a few days. It ended up, we ended up with a nice trade here. Okay, now in fact, actually, after this thing had gotten set up, because of the fact that this thing was actually sitting here for a while, and it took about 3 weeks or so to pull back, when I actually looked at this again, it turned out that there were more option choices that were available than when I had actually set this thing up on July 22nd. Okay, so when this thing arrived here, when this thing got close to arriving on the 16th of August, which is about 3 weeks later, all of a sudden I looked at the option chain, and now all of a sudden there was a November trade. There was a November 18th strike that was there. There was also, excuse me, a November 18th expiration date. There was also one that was denominated where I had actually where I could actually now use a 24 strike rather than the 25. And so as a result, I decided to actually go with the 24th at that point. So I actually changed my strategy here, where I was going to use the October 21st, 25th expiration. Now I changed it to the November 18th and the 24 strike. And of course, one of the reasons is we also want to buy enough time. I always want to have at least 60 to 75 days till expiration when I get into the trade. This way, the trade is not unduly hurt by time decay. The time decay is, generally less injurious than if you're only buying, 3 or 4 weeks. Then if you're in the trade for 10 days, you're going to get whacked with time decay. If you're buying, let's say, 75 days out, time decay is going to be much gentler. So even though you'll be paying more for time to buy more time, when it comes to actually get out of the trade, you will actually then get most of that back. And so as a result, this is kind of like being a value shopper versus just trying to buy options on the cheap. Okay, so right here, this is the setup here. So we ended up getting into the trade right here at 380 at 22.15, and then basically a week later, we got out of the trade at 18.50, and at that point, then the option had a value, that put had a value of 580. So a $2 gain off of 380 represented a 53% gain on this buying this put. Okay, and also when I had looked at the options platform, the option platform was showing that the difference between getting stopped out here versus stopped out here, and that was actually probably for using this one. But anyway, I ended up buying this. I think actually it changed a little, but I just kind of left this in place because I didn't have time to recalculate it. So I ended up buying 4 contracts on this one. Okay, so basically, since we made $2 per contract, and I had 4 contracts, that represented then we ended up with a gain of $800 for those 4 contracts. And again, each of those contracts made about $2. So consequently, four contracts obviously ended up with a gain of 800. So that was that setup. And again, the reason for pulling out of this setup when I did it was because of the fact that, again, I got out right before the earnings announcement. Okay. And the other thing, of course, that happens at the earnings announcement is if you're long a call or long a put, obviously the trade could certainly go your way in terms of the price point, in terms of the price action. of course, always remember that also the pin, though, is going to, in a sense, the pressure is going to come out of the balloon once the earnings announcement comes out, and that's reflected in implied volatility. So consequently, you are going to, if you stay in a trade, after the earnings announcement, obviously you're going to have what's referred to as the volatility crush that will happen once you get out of that trade right after the earnings announcement. So, but like I said, I just didn't really want to take a chance of being in this trade because I had no idea, this just as easily could have spiked up here if there would have been a great earnings announcement. So at any rate, that was the motivation for getting out of this trade. Okay, so at any rate, that's that. And then the last thing I'm going to do is I'm going to show you a couple of quick setups that we're waiting on. And because of the fact that we're having this really, really ugly day today, things are actually pulling back where in fact we may end up potentially, we'll obviously have to see what the tone of the market's going to be on Monday. But in fact, we may actually end up getting getting an entry on one of these setups here. So let me kind of go back and let's find these, let's see, new setups here. So let's find those here. Okay, so as we can see, we basically finished, the market's now closed. We can see we finished right at session lows today. So this is kind of really ugly here. So we'll definitely want to see what the market looks like. We're not just going to dive in to. So here's that Qualcomm. So this is the Qual. Okay, so this is where we got at, and you can see ever since then, it came right back to our level. It got another bounce. But anyway, that was that. All right, so let me find the new setups though that I want to show you here. So let's see here. There was let's see, J&J. Let's see, where's J&J? Okay, so here's J&J. Okay, and we can see, in fact, so right here, if we look right here, notice price. Okay, and this is where price was at the beginning of March. Notice price came up. Notice price came down here, we consolidated, and notice that very, very bullish, energetic candle that fired out of there, okay? So basically, this is about 2 days of trading because this is a 2-hour chart here. So price came down, hung out in here for a couple of days, and then basically then popped and kind of moved from there. And you can see now, price came back to this level, and right now it's knocking right on the door because of this pullback today here. We ended up, you can see it dropped about a little less than 2%. So it's right back, right here, right knocking on this door, right knocking on the door here. So right here, here's our entry, here's our stop. Again, what we're doing is we're expecting that there is untapped upward price pressure that's waiting to be tapped here when price pulls back into this zone. And of course, it depends on the tone of the market on Monday. If we come into Monday and it's showing that the S&P is going to gap down 1.5 or 2%, well then we're not just going to dive into this setup willy-nilly. We're going to basically at least wait for some confirmation for this thing to turn around in this level before we get in. On the other hand, if we start out moderately green or even just break even and this thing kind of just drifts down a little more, we might be inclined to kind of take this trade, but we'll kind of see what the tone of the market looks like on Monday. Okay, so again, this is a demand zone here. Price came down, consolidated, and then fired out of here. Right here, that pop represents an exhaustion of sellers, where the sellers disappeared from this zone. Where right here, the supply of shares and the demand for shares in this level were kind of in agreement, and that's why price went sideways. But then when price popped here, essentially the sellers disappeared, and all you had left was the demand for shares. And so when we have a demand zone here, what we're waiting to do is we're waiting to then go long when price returns to that demand zone. Okay, and so this is what the trade would look like. So basically what we do is we're waiting for this thing to come back into here. That is going to be our entry, and this is how we have it marked up here. So right here, we could express the trade by buying stock here at 164.21. Okay, if we're going to get stopped out, we're going to set our stop about 40 cents below this, so at 161.90. Okay, and then we could either get into the trade by going long on J&J, or we can express the trade by buying a put. Okay, and so this is where we have our notes here about expressing the trade by buying a long call. Excuse me. So right here, what we do is we buy the November 18th call with the 160 strike. The 160 strike would obviously be down here, which would mean we would be buying this about $4 in the money, meaning we would probably be looking at buying this thing with a delta, probably about, I don't know, somewhere between 55 and 60 most likely. And so this is where we would get in. And so as a result, if you bought with the 160 strike, the premium would be just about $10. Okay, which would mean, of course, that each contract would cost you $1,000. On the other hand, if you want to do it slightly cheaper, you could also buy the 165 call. And if you bought the 165 call, that means you would be buying it essentially at the money. Basically you'd be buying it 70 cents under, just out of the money at 70 cents or so. So if you did that, then in fact the premium would be about $7 for this call versus $10 by using the 160 strike. So again, that if you wanted to sort of try to make that a little cheaper, you could use the 165 strike. And then, but either way, that the entry price you would use, you would get in when price returned to 164.21. Okay, and again, your stop out would be 161.90. Okay, and looking at this, the options platform is basically telling me here that if we use the 160 strike, the loss on this would be about $1.30 a contract if we ended up getting stopped out. On the other hand, if you use the 165, well, then there would be about $1. Okay, the difference between the premium here and the premium at the stop out point. Okay, so in either case, though, if we're going to use 250 as kind of our arbitrary risk profile, well, then essentially that means that more or less we'd be allowed to trade two contracts on the 160 strike price would mean you would lose about $1.30 a contract, which of course would work out to 260. On the other hand, for using the 165 strike, well, then you would lose about $1 per contract, and so then you would lose about obviously $200 versus 260. So again, in either case, the suggestion would be to if you're going to use 250 as your number, then you could trade two contracts. Obviously, if you're $500 as your number, you could trade twice as many contracts, of course. Okay. So at any rate, that's one setup for J&J. And then the other one I was looking at, I think, was Emerson Electric, EMR. Where is it? EMR. Here we go. Okay. And again, very similar, as you can see. You're going to see this ugly red candle in chart after chart after chart going into next week, because a lot of obviously if the index was down, well, then obviously a whole bunch of individual stocks are going to show this really ugly candle too. So you can see again, this one's knocking right on the door of this demand zone here. Okay, and so price came up here, kind of consolidated, and then notice the string of very bullish candles here. Along with there's a little outside gap there, and so basically this string of relatively larger green bullish candles here, and so as a result, and then I actually looked at this also, and I think I looked at this in also a lower time frame. So I kind of used this sort of a couple of lower time frame to kind of adjust for this. But we can look at this in the daily chart here. So this is a rally, a base, and a rally here. We're waiting for price to come back here to this demand zone here, and we're again expecting that there is some upward price pressure that's waiting to be tapped in order to then go long out of here. And again, we can express the trade by either going long on the stock or again buying a call. Okay, so again, here's the setup here. Looking at the platform, looking at what the options chain, decided that we're going to express this trade by using the December 16th 80 strike. And so the 80 strike is obviously going to be down here. So we'd be buying this about $4 and change in the money. And I think I ended up using the December because I think then before that, the next nearest one was going to be October. There was no November one there. So as a result, I wanted to make sure that I essentially have enough time. If I get into this with the October, I'm running basically about 60 days, basically looking at about 60 days to go. And I would much prefer to have, let's say, 75 days at least, just so the time to get, because if it all of a sudden is stalled for a while, um, if we were in this trade for a few days, well, then, we would end up kind of taking a hit with the time decay, and it would be much better if we're gonna be in this trade for a few days. I would much rather be holding the December, mid-December expiration rather than the mid-October expiration. The time decay will be much more benign if we're doing that. Okay, so right here, here's our standard entry here, getting it at 84.43. Okay, and then getting it. Okay, and this is where I'll stop out. But I also put in here. One of the things we actually like to look at are we actually use Fibonacci retracements just as sort of a guide to kind of look at, see kind of, well, how does this thing, when this thing pulls back, where is this thing going to pull back to? And right here, this is the 78.6 Fib retracement, and this is the 88.6. I actually happen to be a big fan of when the 88.6 intersects with a demand zone here. And because of the way this lays out here, the risk and reward becomes a lot more favorable if we're a little more patient and waiting for price, particularly in the face of this this really ugly day today. If Monday comes around and it kind of continues down a bit more, I would actually kind of just sit tight and wait for this thing to get to this 88.6 retracement here at 83.32. And if I do that, well, then our entry point, rather than being at the front line of this zone, our entry point is actually then going to be here. And as a result, we can see if this is a 2-to-1 trade, a 3-to-1 trade, a 6-to-1 trade, if we look at, okay, and if we look right here, this is a 1-to-1 trade. If we go from here to here, notice right here, if we're more patient and we wait for this thing to drill it out about $1 into this zone, basically 1-to-1 here translates more or less to 3-to-1 here. It becomes a much easier trade if we wait for this thing to come down here. Now, of course, there's no free lunch. And what's the trade-off? If it doesn't come down there, well, then either you're going to miss the trade, or you're basically just going to have to go with the higher entry here. But this one is at least telling me here that, okay, if in fact I can be patient and this thing shows some signs that this thing is going to drill into this zone, well, then in fact the risk and reward on this trade is going to be much, much, much friendlier using this as the entry point versus that. Okay, and again, in terms of the options platform, if we buy the 80 strike as I described, then the option premium is going to be about 750. On the other hand, if you want to kind of do this trade a little cheaper, what you could do is actually buy this thing very, very slightly out of the money, really just below at the money, and buy the 85 call at 84.43. So you're only about 50 cents out of the money. If you do that, well, then the premium is going to be about 460 if you buy it, more or less at the money. And again, if you buy the 80, well, then you're going to be basically paying 750. So in either case, those are your premiums. Okay. So at any rate, that's what I got. So anyway, kind of went a little longer than I wanted to, but there was kind of a whole bunch of stuff that I wanted to share with you guys. So anyway, I hope you found it useful. Thank you for the privilege of your time. And this is Mitch Firestone, and I will see you guys all next time. Take care.